Volatility is the heartbeat of options trading. It is a key concept that every options trader must understand to navigate the market effectively. It measures the potential price swings of an underlying asset, like a stock. These price swings can be influenced by various factors, including market sentiment, economic data, and company-specific news. Higher volatility means larger price fluctuations, both up and down. This can create both opportunities and risks for traders. Options traders care deeply about volatility because it directly impacts the price of options. The more volatile the market, the higher the premiums on options. When volatility is high, options become more expensive. This is because the potential for significant price movement increases the likelihood of the option becoming profitable. This is because there's a greater chance of the option moving in the money or becoming profitable. Traders must weigh the cost against the potential reward. Conversely, when volatility is low, options are cheaper, the market is calmer, and the likelihood of large price swings is reduced. Traders are willing to pay less because the chance of a large price move is lower. This can be a good time to buy options if you anticipate future volatility. Understanding volatility is crucial for options traders to succeed. It helps them to strategize and manage their risk effectively. By grasping how volatility affects option prices, traders can make more informed decisions. They can better predict market movements and adjust their strategies accordingly. They can identify opportunities to buy undervalued options or sell overvalued ones, maximizing their potential for profit while minimizing risk. Volatility comes in two main flavors, implied and historical. Understanding the difference between these two types is crucial for traders and investors. Historical volatility looks backward in time. It measures the actual price fluctuations of an asset over a specific period, like the past 30 days or even longer. This type of volatility is calculated using historical data, providing a clear picture of how much the asset's price has varied in the past. Implied volatility, on the other hand, is forward-looking. It reflects the market's expectation of future volatility, which can be influenced by upcoming events or market sentiment. Unlike historical volatility, you can't directly observe implied volatility. Instead, it's derived from the current prices of options in the market. Option prices act as clues to gauge implied volatility. When option prices are high, it suggests the market expects higher future volatility. Conversely, low option prices imply lower expected volatility. Traders use this information to make informed decisions about their investments. By understanding both implied and historical volatility, traders can better navigate the financial markets and manage their risk more effectively. When option prices are high, it suggests the market expects higher future volatility. Conversely, low option prices imply lower expected volatility. Volatility isn't always uniform across all option strike prices. The relationship between strike price and implied volatility can form interesting patterns known as volatility skew and volatility smile. Volatility skew typically appears in equity options. Out-of-the-money put options, which profit from price declines, tend to have higher implied volatility than out-of-the-money call options. This reflects the market's natural fear of sharp price drops. Volatility smile is more common in currency options. Both out-of-the-money put and call options have higher implied volatility compared to at-the-money options. This pattern resembles a smile when plotted on a graph. Section 4. Trading strategies for different volatility environments. Different volatility environments call for different options trading strategies. In high volatility environments, strategies like straddles and strangles, which profit from large price moves in either direction, can be effective. Conversely, low volatility environments favor strategies like writing covered calls or cash-secured puts. These strategies generate income by collecting premiums when price movements are muted. It's crucial to adjust your trading approach based on the prevailing volatility conditions. Failing to do so can lead to significant losses. Always analyze the volatility landscape before making any options trades. Section 5. The VIX gauging market sentiment in options trading. The VIX, often referred to as the fear index, is a key indicator of market sentiment and volatility expectations. It provides a real-time snapshot of the market's view of potential volatility over the next 30 days. It measures the implied volatility of S&P 500 index options, which are widely used by traders to hedge or speculate on market movements. A high VIX reading suggests heightened fear and anticipation of larger price swings. This often occurs during periods of market stress or uncertainty. Conversely, a low VIX indicates calmness and lower expected volatility. This typically reflects a stable market environment with fewer anticipated disruptions. Options traders use the VIX as a gauge for potential trading opportunities. By analyzing VIX trends, they can make informed decisions on their trading strategies. A spiking VIX can signal an impending market correction, which might present attractive opportunities to buy put options. This is because higher volatility often leads to increased option premiums. A declining VIX, on the other hand, might favor strategies like selling volatility. Lower volatility can result in lower option premiums, making it a good time to sell options. Understanding how to interpret the VIX is a valuable skill for any options trader looking to profit from market sentiment and volatility changes. Mastering this can significantly enhance one's trading performance and risk management.